Hey guys, welcome to another VC Wisdom podcast with a guest that you might recognize. He's already been on the pod, Philip J. Pipkins, founding partner at Prospect. We had a nice convo last time. Lots of things happened since then. So I believe it was a bit before Christmas, the last time we spoke, Phil. There's been a lot of stuff. Phil has a background at SVB, and I want to talk about the crash, although it's like old news, but we're still feeling the reverberating effects of SVB. So I want to start, Phil, by talking a bit more about SVB and its current effect on the VC ecosystem and so forth. If you can help us with that.
Yeah, no problem. So again, thanks for having me. And just to level set, I was at Silicon Valley Bank coming up like a year ago. Left to start at Prospect, but in that time, they were very helpful. They were putting on events, helping us with events, definitely helping in the ecosystem, and vice versa. And they were sending us deal flow, heavy deal flow. So with that being said, with this crash at SVB, the main issue that people haven't really felt or seen yet is going to be the fact that SVB had 54% of its revenue was through cap call lines. So a cap call line is extremely helpful for fund managers because that allows them to basically goose their IRR, and it also allows them to deploy capital very quickly. I mean, right now I'm having an instance where I'd like to deploy $1 million, and it was within about 4 days. And when we send out cap calls, our LPs have like 10 days to send the money in. So that speed to capital is not going to be there. And those cap call lines are a very specific product for VCs. They're very short term. They're pretty much 100% backed. And that product is what SVB's main bread and butter was. From the outside looking in, it looks like their main client is the startups, but their actual main client is the VCs. So with SVB being gone, the VC ecosystem is going to have a little bit of a problem because VCs were getting free banking from SVB. I've been looking at top four banks and things of that nature. I'm definitely not. My fund is not big enough for me to be able to get free banking, so I don't know where I would go to replace like an SVB type situation.
What do you mean by free banking? Like, if I want to start my fund and I have some track record, do you mean that SVB can help me raise like at least 10 million or can refer me to others, or just that you're not paying like a big monthly fee for cash in the bank?
The latter. So you're not paying to send. So as a VC, basically you hold money in an account sometimes, or you're doing a cap call, and then you basically send all that money out over time. So with that being said, the only product that you really need is wires, and hopefully some sort of interest bearing account. Wires sometimes could cost like $25 per. And again, in terms of the fact that you are holding the money there and then you're bringing your portfolio companies to the bank, there's a mutual beneficial situation for you bringing clients in. So then they give you free banking because you're frictionless in terms of the amount of effort it takes for them to administer your type of account.
Right. Let's talk about the human psychology side of things. Like, let me try to give a nice summary of what happened. So like founders and VCs were already stressed from like really crappy quarters, inflation, and everything in between. And basically, SVB were lousy. With the leadership of SVB was lousy, and kind of considering all of this and reacting the proper way. So like PR, right? Which is why PR is somewhat important in this day and age where humans are still very much reactive. Um, they kind of did an announcement. Everyone freaked out, and then Peter Thiel and his buddies told everyone to like withdraw the money, which is a valid concern, by the way. Like it could have happened, and it was kind of the typical win lose Machiavellian theory of everything that is very much prominent in the Thielverse, and everyone withdraw their money, that crashed the bank. And yeah, so the founders were mostly safe, and everyone else got in a sinking boat. So that happened. So what are your thoughts on that description of my very biased description?
Yeah, pretty biased. Yeah. So from my standpoint, it was mainly essentially SVB is really good at venture debt, ecosystem building, curating relationships. And what they did was they took the money that they made from that huge bull market and then they invested it in bonds, which unfortunately have gone down in value. So they took huge amounts of value and put it into something that was supposed to be extremely safe. And then they had to sell it way too early. And in selling it, that meant that they needed to raise money, which is totally fine. Banks, startups, everyone has to raise money. The main thing is that it doesn't seem like SVB was as good at raising money as their clients were. And so having to go out and say, hey, we need to raise money kind of gave a little bit of a fear to the market. But on the flip side, the other thing is, so through the entire, 50 years of SVB's life, the main thing that they always focused on was making sure that these startups and these founders were taken care of. So when COVID hit and it was, PPP situation, their main mandate was that we will not default on these loans. We will do everything we can to make sure that these founders are good to go. So they extended out the interest only. They bent over backwards to make sure that these founders were good to go when there was a time of need. The irony is that when there was a time of need for SVB, the founders couldn't care less. And
Right.
the main thing is that startups are the worst type of client for a bank, right?
Okay.
You put your money in there and then you burn it away. So the
Right.
whole point of a bank is that they want you to have your money sitting there so that they can lend it out. If you're going to
Right.
burn through it, they can't lend it out. And then the other thing is they want you to use their services. And startups are notorious for not using banking services, right? You use Stripe. You probably got a Brex credit
Right.
card. You got you got every single fintech under the sun, and you're not using a bank. So when a startup comes to the bank is looking at them like, okay, so you're not going to use our products. They're going to burn through all your money, and we can't lend to you because you don't have anything to collateralize. So a bank looking at a startup, they're like, basically next. But a startup thinks that they're hot stuff because SVB has treated them like that this whole time. With SVB being, and again, SVB is not gone, by the way. They are just owned by First Citizens Bank, their
Right.
division of it. But HSBC has taken 75 people from SVB, and I think Stifel Bank has taken another 45. So with those bankers and their relationships gone, I don't see Silicon Valley Bank being what it used to be. I'm sure that the folks that are still there are going to try to pop. That knowledge base is now gone to other banks that can capitalize on that because they have more money.
Right.
But in HSBC, I don't know if they're going to really go all the way downstream and offer free banking to VCs and discounted banking to every startup under the sun. We'll see if
Right.
that happens. But that's what
Right.
SVB was doing the entire time.
HSBC clients of theirs, they're very, very conservative. To what you just mentioned, it's kind of a diplodocus vs an army of velociraptors, or an army of, let's say, wolves, which are startup founders. Diplodocus is slow moving. They're conservative, and that's probably good by nature, right? The bank shouldn't like be a poker player taking risks left and right. It should be like a base. It should be an ecosystem. It should be something safe. But yeah, you're right. Founders are not super good clients. They're, like I said, I think, are very Machiavellian and win-lose, especially in these situations that economy was so dire. And I think they got really primal. It's like, it's you or it's me. That was the kind of mindset. And then, well, me, what I didn't like is that most of them ended up like, oh yeah, have pity on us. Then after that, like, they really freaked out. They really got primal real quick. Anyway, the situation got solved. I predicted a couple of other banks would follow up crashing, and they actually did. There were 5 banks that crashed. That was probably my predictions also this year. I think the hemorrhage is mostly stopping, and I also think this is kind of a new evolution, right? It's a painful evolution from caterpillar to cocoon, and then from cocoon to butterfly. I think we're gonna see a huge upshift in this new economy, with amongst others fintech. I do think that other technologies are gonna change the world. One of them is WorldCoin. We've seen us enter the age of AI. What do you think the future of VC and startups and fintech will be like with all the exponential changes we've seen this year in the market?
Yeah, I mean, so to start on the VC side, a savvy VC can definitely cut down on the administration in the background that they have, which will cut down on the operational costs that they'll have. And when you're looking at a AI startup, it is very feasible to think that you could give them 50, 100K and they could get something spun up very, very quickly that can capture a lot of value. That's what we've been talking about. That's what VCs have been looking for the whole time. They haven't seen that for like probably 10 years. But I think that this is a good time. There is basically a paradigm that is clear that everybody is moving towards it, similar to mobile. It clearly is going to be working for both laymen. So like my mom can use Chat GTP just the same way that I could. And again, with the fact that there'll be smaller teams that can build more, that is a great thing for VC. On the flip side, there are going to be companies that are going to be cannibalized because they either had the idea that they were going to have AI built in, but they built their company before all of these new paradigms have come out and these capabilities. And so they're behind the curve now. And then there are the other companies that basically with this new technology and new efficiency, they're not needed anymore. So, you could always, there's a lot of things that will just go away because there won't be a need for you to have such a large tech stack. You'll basically just have, AI built on top of it. But I think that this is a great time. On the fintech side, I do think that it is going to be a little bit painful for these fintechs for a couple of reasons. One, the interest rates are gone up. So whatever type of fintech, if you're lending money and you don't have fractional banking, then your cost of capital is going to be way higher than a bank. On the going against that as well, because you are your main value add is being layered on top of the bank. And right now, the sentiment is that even a bank that's 100 years old, people are looking at it with the side eye. How are they going to look at a company that's 18 months old? Nobody in this company has had any sort of banking background, but you have a couple of clients. The likelihood of you being able to capture a lot of market 3-4 years ago was high. Now, not so much because it's a flight to safety, and safety comes with longevity and with the big balance sheet. And so I do think that a lot of these neo banks are going to feel the burn. A lot of the lenders are going to feel the burn. And the only people that are really going to be probably safe are going to be the payment processors like Stripe, because you still got a payment process. And, that cost is pretty much the same, but lending and banking have definitely gone up in terms of cost.
Right. I wanted to ask you one of my weird thesis, and I do agree that like the check size, the cutting smaller check size is indeed relevant. I especially love the aspect of it that you can get the internal view of the ops of a new AI company, for example, and really learn off that, and that can have exponential effect. Actually, that's my number one reason to get in VC and private equity. I've started funds this year, but then I had the other thesis, which was, is the capital leverage gonna disappear? I think the ultimate answer is yes, but like when exactly? In 10 or 15 years? Because the logic is the following: with AI and AGI, let's say that we have it in 5 to 10 years, which is very short runway, by the way, but let's say that we have that in 5 to 10 years. I think startups are going to bootstrap themselves from the start, because they can also be they would also be almost instantly be able to make money from day one. And which would prevent them from needing money. I think more and more people are against VC money nowadays, but I mean, it's still our very human nature to be like, okay, yeah, free money or almost free money, let's say. Let's accept it. Obviously, folks are starting to think that, yeah, it's not their money and they need to be careful about that. There's also that principle. So with all of that, I'm like, should I start my fund if it's going to be like something profitable or fun for even 5 to 10 years? Yes, there's the learning thesis in which I can have a direct view of the operations of the startups I invest in, which I very much like. But will it still be a profitable thing to do? Will the leverage, will the capital leverage disappear? Because in my book, there's three main leverage. There's the human leverage, which has disappeared already, in my opinion, with ChatGPT as your assistant and so forth. There's the capital leverage, which is obviously nice. It's like more energy I can invest and build quicker, and speed is important for market penetration. And finally, there's the software leverage with the AGI kind of leverage, which is the most prominent one. Do you think the capital leverage will disappear anytime soon, is my question.
No. So the irony is that VC-backed companies are now opening our eyes to what like 99% of every other company in the world has to do, which is make money or you will die tomorrow. So we're just coming full circle to how regular businesses are run. You got to make money in order for you to continue on. But at the end of the day, no matter what, it is going to be extremely difficult for you to have organic, natural, high growth. All companies go and get loans. They might not go get VC, but they go and get loans in order to grow, because it is, again, very difficult for you to just grow based off of your free cash flow. So with that being said, I don't think that the capital leverage will go away. I think that depending on how you are administering your capital and your knowledge base, if you were, if you were pretty elementary in that, okay, you're an early stage investor, you were just going off of whatever the market was, putting money into whatever company came across your face, yeah, you will die. But the financial savvy VCs, there's a lot more levers to pull. Right? I mean, I know about debt and VC, so there is still a lot of opportunity to provide capital to companies in a structure that will make you, as the fund manager, money and give them the breathing room necessary for them to grow their company. I don't see that going away soon. And even if you were able to bootstrap your AI company, I mean, think about the person that's going to be able to do that. It's an engineer. How many engineers have you met that you were like, this is going to be an excellent CEO of a company? Yeah. Not that many, right? There's a certain type of person that's going to be a builder by night that can do that. They're usually a 0 to 1 type of person. There needs to be someone else that comes in that can then get them to the 10 million, to the 100 million, to the $1 billion. Because the heavy builder is not that person. So you need money to buy those people. You need money to entice those type of people to come to your company. Facebook would not be anything it was without Cheryl. So you can have Zuck, but without Cheryl, it's nothing.
Right. Yeah. Well, I mean, I can picture a future in which there's a generalist that is probably 8 or 9 on 10 in all skills, which is a hard thing to do, indeed. But they would manage a bunch of auto GPTs that would kind of execute the task for them. And I can picture that future very soon. But yeah, it's certainly an interesting point of view. For example, I checked the Pinecone. I think they finished raising yesterday 200 million, their Series B. I had two thoughts on that. My first thought was like, oh, what a win for the VC. Second was just 200 million. That's not a lot for a Series B for an AI company. It should have been at least 1 billion. And three, it was like, oh, do they have enough paid subscribers? But to your point, you're mentioning that, yeah, hooking up customers organically is quite hard. Another good example of, to support your point, is obviously OpenAI. like huge rounds of funding, 10 billion by Microsoft. So that's huge support. They just reunited the best people in the world in the same room, and they built something quite nice. So I do indeed think that this gives a lot of fuel to your argument. Any other thoughts on the convo of today, Phil? Because I know that you need to run. Where can people find out more about you online?
Yeah, no problem. So you can find me on LinkedIn, whatever it is, linkedin.com/PJ Pipkins, I believe. You can find us on the website, prospect.co. Still doing venture debt, still investing in companies that are doing over $1 million in revenue, looking to grow. We got check sizes of 500K to 2 million. And right now we actually got 4 companies in the portfolio. So, things are definitely going good. And there's more of a deluge deal flow coming with the SVB fiasco.
Yeah, exciting time.